The stock market crash. Should you panic or profit? The fear factor. The stock market is finished. Get out now before Trump causes a full-blown recession. That's what the headlines are screaming. Social media is in chaos, investors are panicking, and everyone is asking the same question: should I sell before it gets worse? But let me tell you, there's more to this than meets the eye. If you've followed me for a while, you know I'm obsessed with the stock market. And since so many of you started investing because of my videos, I feel responsible for giving you the truth, not fear-mongering. So before you make any rash decisions, let's take a step back and look at the bigger picture. Every market crash has a cause, and this one, it's not random. There are 3 key triggers, and all of them trace back to one man, Donald Trump. Now, before anyone gets political, let me be clear, I'm not here to take sides. As a British investor, my only concern is how this affects your money. So let's break it down. Trigger 1. Trump's trade war. Trump built his reputation as the ultimate deal maker. He fights for American jobs and plays hardball with other countries. But here's the problem: trade wars can backfire badly. The last time the U.S. took this approach was 1930 with the Smoot-Hawley Tariff Act, one of the worst economic blunders in history. It was meant to protect American businesses, but instead, other countries retaliated, global trade collapsed, and the Great Depression followed. Fast forward to today, February 2025. Trump slapped a 10% tariff on Canadian energy imports and a 25% tariff on other Canadian goods. Canada retaliated, a 25% tax on U.S. imports. March 2025, Ontario raised electricity export charges by 25% to U.S. states like Instead of backing down, Trump doubled down, raising tariffs on Canadian steel and aluminum to 50%, crippling Canada's manufacturing industry and raising steel prices for U.S. businesses. And here's where you feel it: higher prices on cars, appliances, electronics, and even food. Supply chain disruptions make essentials more expensive. Other countries are moving away from trading with the U.S., strengthening the BRICS alliance: Brazil, Russia, India, China, and South Africa. So, what's my take? While some industries might benefit in the short term, the long-term damage, higher prices, weaker global trade, and a slower U.S. economy could outweigh any benefits. But here's the twist: I don't believe Trump actually wants high tariffs. What's Trump's real game? At his core, Trump is a businessman, and I think he's using tariffs as leverage, not an end goal. What does he really want? A trade deal that favors the U.S. But here's the danger: uncertainty kills investor confidence. Markets don't just react to tariffs, they react to uncertainty. Investors don't know what's next, and uncertainty leads to panic.
2. NATO and global stability. Trump has questioned NATO's role, suggesting the U.S. shouldn't defend allies unless they contribute more. While that might sound fair, it creates global instability. If NATO weakens, Russia could push further into Europe. More conflicts mean higher military spending and volatile energy prices. Markets hate uncertainty, and the second investors sense instability, they panic. Trigger 3. Is Trump crashing the market on purpose? Sounds crazy, right? But hear me out. Trump has always hated high interest rates. He's called them ridiculous and repeatedly attacked the Federal Reserve for keeping them high. Here's why this matters. The Fed is independent. Trump can't just order rate cuts. But the Fed reacts to economic conditions. If the stock market crashes and recession looms, the Fed will be forced to cut rates. Why does Trump want this? Because high interest rates hurt growth. And here's the biggest reason: U.S. debt. The U.S. government owes $36.5 trillion, and when interest rates are high, paying off that debt becomes a nightmare. Think of it like this: you owe $336,500 on a credit card with 10% interest. You're paying $3,650 per year just in interest. If the bank lowers your rate to 3%, your interest drops to $1,095, saving you $2,555 every year. Now apply that to $36.5 trillion. Lower interest rates could save trillions in government debt payments. If this theory is true, Trump isn't crashing the market for destruction, he's setting up a massive rebound. How can you profit from this crash? Stock market crashes aren't disasters, they're opportunities. Every major crash in history has been followed by a recovery. Here's how to position yourself for massive gains. Step 1. Invest while the market is down. Before investing, secure your financial foundation. Build an emergency fund 3-6 months of expenses. Pay off high-interest debt greater than 8%. Then invest while stocks are cheap. 2008 financial crisis example. Many panicked and sold at the bottom. I kept investing and my portfolio doubled within a few years. Want to start? Trading 212 is offering a free fractional share worth up to £100. Use code Tilbury in the app link in description. Step 2. Stay disciplined and think long-term. Market crashes follow cycles. Corrections 10 to 20% drops. Common and healthy. Bear markets 20 to 40% drops. Last approximately 289 days on average. Full collapses greater than 40%. Rare but followed by huge recoveries. Biggest mistake? Panic selling. Smart move. Invest consistently dollar cost averaging. By every month. No matter what, ensuring you accumulate wealth over time. Step 3. Diversify your portfolio. Don't put all your money in one place. My portfolio includes stocks, dividend paying are great in downturns. Bonds for stability. Gold and precious metals, a hedge against crashes. Real estate, cash flow. Crypto, long-term growth. Final thoughts: market crashes aren't the end of the world. They're an opportunity.